So where are we year to date? Um, Markets are largely down across the board. You can see here the S&P 500 is down nearly 8%, a little bit more than that, closed tonight or today at 4327. You can see the NASDAQ tech heavy index is down even more at 12%. The Russell 2000, also a representative index of smaller cap stocks, down nearly 12%. All in all, about $5 trillion of market value has been wiped off balance sheets year to date 2022. So we're off to a tough start in the year in terms of market values, but it's balanced or tempered by a couple of, I think, really strong fundamentals. One is corporate earnings. And as we look at and we hear more about corporate earnings during earnings seasons, what we're seeing is corporate earnings are up about 24% in the fourth quarter of 2021. And that's what they're reporting now, which is a very strong increase in earnings. And just today, we had an announcement on GDP, the growth of GDP. It's up an annualized rate of 6.9%, nearly 7%. So those fundamentals are very strong. They're not reflected at all in the market year to date. And really, there's not been any sector that's been spared the carnage other than energy. But you can see across the board, across everything but energy, that the year-to-date performance across sectors is negative, reflecting the broader market indexes. One of the observations as I was preparing this is looking at domestic versus international stock values. And this graph is meant to show a relative value of domestic stocks relative to international. When the line is upward sloping, that means that domestic stocks are outperforming international. When it reverses and the slope is downward trending, it means that international stocks are doing better than domestic stocks. And it's been a while, but we're seeing kind of a pronounced trend of a reversal of valuations, in part due, our domestic Fed is backing off stimulus and accommodation, whereas in the European Union, central banks there continue to be more accommodative. And even in China, you would say that the bank there is being stimulative of the economy. So it's another kind of evidence of the impact of Fed actions across markets. So I thought that was worth noting. But if we go back to the last 180 days, if we focus on the S&P 500, you can see that we're down a little bit more than 10% from the highs in late 2021. We've fallen from a high of around 4765 to something around 4325 today. It's a correction. It's over a 10% decline. And I think that it's important that we think about this in terms of context. When we have these declines, 10%, it's scary and it creates volatility and it creates concern. But if we think about it in a broader picture, and if we go back and reflect on Chris's investor letter going back the fourth quarter of 2018, what Chris reminded us of is that a 5 or 10% correction in the market really is very normal. And in fact, we would expect up to 3 pullbacks of 10% of corrections, somewhere between 1 and 3 every year. So, and then also roughly every 3 years, we would expect to have a 20% pullback or decline. So the fact that we're starting the year with a 10% decline, it's ominous that it's the start of the year, but it shouldn't be viewed in a historical context as really outside of the norm. Here's another way that we can look at it. This is a chart that shows the S&P 500 and the max decline that occurred in the year. That's the dot, kind of the teal colored dot in the graph, and then the ultimate calendar year return. And why don't we look at the return in 2020? As you can see, in 2020, the S&P 500 returned 16%. And by historical standards, that's a very generous, very handsome return, 16%. But what's easy to forget sometimes is that to earn that 16% return, you had to withstand a 34% drawdown in values at some point during the year. And if any of you can remember in 2020, in March, there was a really steep, precipitous drawdown that was frightening. It was alarming, and it was a 30% drawdown. If you weathered through that, you had a 16% return for the year. And as what we can see is, even going back the last 40 years, that drawdowns in the market are to be expected, and with some frequency. So I think that it's helpful to have a historical context as we think about the current market volatility. So what's driving it? There's a number of things. Global conflict or the potential of it, and many other factors. But the most important factor is really the market's reaction to the Fed and anticipation of changes in Fed policy. I found this graphic on the internet. I thought it was apropos of the levers that are available to the Fed and how it affects the market. So I thought we'd just transition here and let's focus on the Fed for just a moment. First of all, I think it's helpful to be reminded of what the Fed does. The Federal Reserve exists to maintain a stable and growing economy through price stability and full employment. It's two legislative mandates. Now, traditionally, a growing economy, the Fed had been targeting something around 2 to 3% inflation. And as you recall, over the last decade or so, it's really been a struggle for the Fed to stimulate an economy that had a 2% to 3% inflation rate. I mean, it's just another example of careful what you pray for. In terms of full employment, historically, an unemployment rate of somewhere around 3 to 4% is considered full employment. Today, unemployment's at about 3.9%. So the Fed has been working towards these two targets, 2 to 3% inflation, 3 to 4% unemployment, as their marks for price stability and employment in the market. So they have a number of tools. The Fed has a number of tools available to them. Jerome Powell is the Fed chair. The two primary tools, traditional tools, have been first, manipulating short-term interest rates. And the Fed does that through setting the Fed funds rates. Today, the Fed funds rate is at about 0.25%. And the way that the Fed manipulates rates through the Fed funds rate is it establishes a Fed funds rate, but it also, by doing so, when it lowers rates, for example, so it's trying to stimulate the economy, they'll lower rates in an effort to make money cheaper to borrow and less lucrative to save, which encourages individuals and corporations to spend. That's a stimulative effect in the economy. When they raise rates, as they're about to do or have signaled to do, it has the opposite effect. It takes money out of the economy because people are more interested in saving money as opposed to spending money. So it's really interesting, I think, if you look historically. Here's a graph just over the last 22 years of the Fed funds rate relative to the two-year Treasury yield. And you can see the tight correlation between the two. So the Fed has a lever through the Fed funds rate that really has a very immediate impact on and pronounced impact on short-term rates. So that's one way that the Fed controls or has a lever in the market. Another is through open market operations. And open market operations is when the Fed buys or sells Treasury bonds in the open market. And it's akin to directly manipulating interest rates and the supply of money. So if the Fed, for example, buys bonds in the open market, it increases the money supply by swapping out bonds in exchange for cash. They're spending cash to buy bonds. In addition, when the Fed buys bonds, interest rates are pushed lower because there's a demand for bonds. And the opposite occurs when the Fed begins to sell bonds in the marketplace. Here's a graph that I thought was really interesting. It looks at what's called the Fed's balance sheet. And today the Fed has nearly $9 trillion of securities on its balance sheet. So it's been very stimulative in the market, buying bonds, which has the effect of lowering interest rates and putting more cash or more money into the economy. Today, the balance sheet is about $8.75 billion. And you can see just very recently, even as recent as 2019, that the Fed's balance sheet was 3.75 billion. So it's more than doubled in that short period of time. And you have a sense of the historical levels of the Fed's balance sheet. So they've announced two things. One is that they are going to no longer be buying bonds as of February. That'll be their last round of purchases. But in addition to that, they're going to be reducing their balance sheet. And many market commentators and observers will point to the Fed's open market operations and their selling and how they're going to sell and reduce their balance sheet as really being one of the most consequential actions that they'll have in the market. So they obviously have been signaling an increase in Fed funds rates, short-term rates. They've also signaled that their open market accommodations are meant to raise interest rates. And the effect of that has been higher interest rates. If we look at the 10-year Treasury yield over the last 180 days, interest rates have increased over the last many weeks. And today the 10-year Treasury is trading at about 1.85%. So one last observation as we think about the Fed and Fed rate hikes, in 2013, when the Fed started to pull away from their bond buying program, it was called the taper tantrum. And very often, because of the volatility, Fed rate actions can seem on the surface to be a negative thing. However, historically, again, putting these things into context, if we look historically at Fed rate cycles over time, going back to the 1950s, the market predominantly has done well during Fed rate cycles. The only exception to that was in 1972 to 74, and it makes sense. Because if you think about what the Fed is doing, is they're trying to, through rate hikes, cool or tamper down a hot market and a growing market. And in growing markets, that's when corporations have higher earnings and the economy is humming along. So the point is, don't interpret or conclude that a Fed rate hike like we're going through today, even though it creates volatility, we've seen that many times in the past, don't conclude that it's going to be a negative influence or impact on the market, because the history doesn't support that.